Welcome back to our Structured Finance Masterclass. In this chapter, we're diving into two ideas that are, well, absolutely foundational to how markets work: market efficiency and price discovery. These concepts are so critical because they explain how the prices you see on the screen every single day are actually formed and why they behave the way they do. So let's start with a really basic question. Who actually decides the price of a stock? I mean, have you ever stopped to think about that? There's no committee, right? No CEO or government agency says, today Apple stock will be this much. So where does that number actually come from? And that leads to a second, even deeper question. We hear this term all the time: efficient markets. But if markets are so efficient, why do prices still swing so wildly? Why do we have bubbles and crashes? I mean, if the price is always right, why does it change every single second? It seems like a contradiction, doesn't it? Well, today we're going to clear that up. So here's our game plan. We'll start by figuring out how prices are actually formed. Then we'll define what market efficiency really means and look at its three different forms. After that, we'll explore why markets in the real world aren't perfect, how efficiency can change over time, and wrap up with the most important practical takeaways for you. Okay, so let's tackle that first big question. How are prices formed? The best way to think about it is to imagine the entire market as one giant, continuous, never-ending auction. This process has a name: price discovery. Now, the key word here is process. Prices aren't set, they emerge. They emerge from the constant interaction of millions of buyers and sellers, all acting independently with their own information and their own goals. It's a bottom-up thing, not a top-down decree. And this classic supply and demand chart, it's the perfect illustration. Just like with anything else, it all boils down to this balance. The price you see on the screen is simply the equilibrium point. It's that sweet spot where the number of shares people want to buy exactly matches the number of shares people are willing to sell. But here's the thing, that point is never static. It's always shifting. So think about it. Let's say a company releases a fantastic earnings report. Suddenly, a lot more people want to buy the stock than sell it at its current price. That's excess demand. So what happens? Well, the buyers have to start offering a little more to tempt sellers to part with their shares. That bidding action creates upward pressure, and the price climbs until a new, higher balance point is found. And of course, it works the other way too. If some bad news breaks and everyone starts rushing for the exits, you get excess supply, way more sellers than buyers. Now sellers have to lower their asking price to find anyone willing to buy. That creates downward pressure, and the price falls to a new, lower equilibrium. This constant push and pull, second by second, that is price discovery. Okay, so now we can connect this directly to our next big idea: market efficiency. And honestly, this is probably one of the most misunderstood concepts in all of finance. The best way to think about efficiency isn't about whether a price is correct. It's about speed. How quickly does new information get absorbed into that equilibrium price we just talked about? This is such an important distinction. An efficient market can still get the price totally wrong in hindsight. Why? Because if the collective belief of millions of people is based on flawed information, or even a shared delusion, the price will simply reflect that flawed belief. Efficiency just means the price is a really fast and unbiased mirror of all the available information, good, bad, or even flat out incorrect. Now, to make this idea more useful, economists have broken efficiency down into three different levels. See, it's not really an on or off switch. It's more of a spectrum, and it all depends on what kind of information has been baked into the price. You can think of these as a kind of ladder. We start at the bottom with weak form, then climb up to semi-strong, and finally reach the very top with strong form efficiency. Each step up that ladder means a wider and deeper set of information is already reflected in the stock price. All right, let's walk through this. At the first level, we have weak form efficiency. This just means that today's price already reflects all the historical price data and trading volumes. The practical implication of this is huge. It means you can't consistently beat the market just by looking at price charts for patterns. That whole field of technical analysis, weak form efficiency, says it's not a reliable edge. And most major markets are considered at least this efficient. Okay, next up is semi-strong form efficiency. This is a much higher standard. It says the price reflects all publicly available information. That means not just old prices, but also news reports, earnings announcements, analyst ratings, you name it. If a market is semi-strong efficient, then by the time you read about some good news online, that information is already in the price. It makes it incredibly tough to profit from fundamental analysis based on public info. And finally, we have the theoretical peak, strong form efficiency. This suggests that prices reflect everything, all public information and all private insider information. If this were true, not even a company's CEO could profit from their secret knowledge legally or otherwise. As you can probably guess, this is more of a theoretical benchmark than a reality in any market. So, if we generally believe that most markets are at least semi-strong efficient, why does it still feel like there are opportunities out there? Why do prices sometimes seem just wrong? Well, it's because the real world is messy. There's friction in the system that stops efficiency from being perfect. These frictions usually fall into three main categories. First, information doesn't just magically appear for everyone at the same time. Second, we humans, well, we're not exactly the perfectly rational robots that economic models assume we are. And third, the actual mechanics of buying and selling have costs and delays built into them. Let's just touch on the behavioral side, because it's so fascinating. We see clear evidence of both overreaction and underreaction. Sometimes, investors get way too excited about a trend and push a stock's price way beyond what its fundamentals justify. That's overreaction. Other times, the market is just too slow to understand the full impact of some new complicated piece of information, leading to a delayed price move. That's underreaction. And then you have herding. This is a big one. Instead of doing their own homework, people just follow the crowd. It feels safer, right? But this can create these powerful feedback loops that fuel market bubbles, where prices detach completely from reality, driven more by social psychology than by financial analysis. And all of this brings us to a really crucial, practical point. Market efficiency isn't a static thing. It actually changes depending on your time frame. The market behaves very, very differently over a few days than it does over a few years. In the short term, markets can be a chaotic mess, driven by sentiment, by fear, by greed, and by momentum. This is where all those behavioral biases we just talked about have their biggest impact, and where prices can get pretty disconnected from their true value. But over the long term, things tend to sort themselves out. A company's actual earnings and its fundamental value act like a kind of gravity, eventually pulling the price back toward a more rational level. This is the whole idea behind what's called the adaptive market hypothesis, that efficiency isn't a fixed state, it's an evolving process. All right, let's bring this all home. What are the big, practical takeaways from all this theory about price discovery and market efficiency? What does it actually mean for you? Well, I think the single biggest mistake people make is confusing the word efficient with words like perfect or safe. And that confusion can lead to some really dangerous assumptions about how markets actually work. So let's be crystal clear. An efficient market does not mean prices are always right. It just means they reflect what's known. It does not mean you can't make money. It just means that, on average, your returns should match the amount of risk you take. And this is the most important one. An efficient market is absolutely not a risk-free market. Efficiency is about how quickly information is priced in. And sometimes that information is awful, which can lead to very fast, very sharp price drops. So, to quickly recap our key ideas. Price discovery is that continuous collective auction that sets market prices. Efficiency is simply a measure of how fast new information gets absorbed into those prices. Inefficiencies pop up because of delays in information, our own human psychology, and frictions in the system. And finally, for any investor, your time horizon is one of your most powerful advantages, allowing you to ride out the short-term noise and focus on the long-term fundamentals. I really hope this session helped clarify how prices are made and what efficiency truly means. Getting these concepts down is absolutely essential. In our next chapter, 1.4, we're going to zoom in even closer and look at the nuts and bolts of trading itself in the world of market microstructure. I'll see you there.